Hey everyone, and welcome to This Explainer. Today, we're diving deep into what it actually takes to build, ship, and honestly, just survive in the modern financial technology landscape of 2026. Because let's be real, beyond the super sleek, shiny interfaces we all use, there's a lot going on. We're going to uncover how teams balance high-level product strategy, how they navigate absolutely crippling legacy tech, and how they master the beast that is regulatory compliance. So whether you're hustling at an agile startup or trying to steer a massive legacy banking giant, buckle up because we're exploring this whole ecosystem together. To really grasp the stakes here, just consider this absolutely wild number. In early 2025, digital payments accounted for a staggering 99.8% of transaction volume in India. 99.8. We are living in a world where digital-first finance is literally no longer an alternative, it's the absolute default. The shift, it's completely happened. But, behind those seamless instant mobile taps is a chaotic, incredibly high-stakes operational reality that product teams have to navigate every single day. And that brings us to what is essentially the golden rule of this space. Building a fintech product is absolutely nothing like building a consumer social app. Think about it. If your social app goes down for an hour, your users are just kind of annoyed. But if your fintech app fails to reconcile an ACH transfer, you might trigger a false overdraft cascade, and boom, you've just invited serious regulatory action. So building fintech is really a constrained innovation game. It's defined by systemic risk, not just flashy features. Section 1. Legacy Tech, the anchor. Okay, so let's talk about the massive anchor that's holding back so much of the industry right now. Delivering features in an incumbent banking environment is notoriously hard. It's incredibly slow, and it is staggeringly expensive. Look at the contrast here. Neobanks can deliver features at a cost of roughly £20 per customer, but incumbent banks, they're sitting closer to £150 per customer. That is a massive difference, and it's driven entirely by 40-year-old mainframe technology. Incumbents are spending the vast majority of their bloated IT budgets literally just to keep the lights on, leaving almost nothing for genuine innovation. Now, you might be wondering, well, why not just upgrade the systems? Well, there's a famous industry metaphor for replacing a core banking system. It's like switching out the plane engines while you're currently flying. It is terrifyingly risky and massively expensive. We're talking about decades of bizarre edge cases and undocumented, duct-tape workarounds buried deep inside these legacy mainframes. Moving millions of customers to a new platform means you risk exposing all these known unknowns. Honestly, a full migration is a career-ending risk for a lot of banking executives, so they just avoid it. If you want to see how this tech gap actually plays out day to day, just look at release velocity. Because they use a digital native architecture, a neobank can safely release code tens of times a day, every single day. Meanwhile, traditional banks have fought tooth and nail, spending millions just to improve their release cycle to maybe once a month. Fintechs can offer totally transparent pricing, much lower operational costs, and account onboarding in literally minutes. Legacy banks? They're still bogged down by physical branch dependencies and incredibly rigid, slow KYC processes. Section 2. The strategist versus the tactician. Navigating this incredibly high-stakes environment requires a very specific division of labor. You really can't do it all. And this brings us to a core distinction that is absolutely necessary for survival. You have your product manager, who is the strategist owning the what and the why. And then you have the product owner, who is the tactician owning the how and the when. But listen, they don't work alone. They are heavily supported by business analysts, who act as absolute requirement specialists for complex things like KYC. Plus, you've got project managers who step in as the crucial execution and risk stewards, guarding against the pitfalls of that legacy technology we just talked about. Let's break down how this dynamic actually works. Let's start with the product manager. The PM operates at the high strategic level, but here's the major twist for fintech. They absolutely must possess financial system literacy. They have to deeply understand how things like float, hold periods, and settlement cycles are going to impact the unit economics. If a PM can't map a seemingly simple user story directly to a general ledger impact, they're going to ship features that completely break the company's business model. Their primary job is balancing aggressive user growth with the company's strict risk appetite. Meanwhile, the product owner steps in to embed directly with the engineering teams. They're the ones ensuring those massive, complex compliance visions actually get built perfectly to spec. They take the incredibly intricate compliance rules documented by those business analysts, manage the backlog, and handle all the crucial exception handling. And all the while, the project manager is right there, tracking the overall delivery risk against those stubborn legacy system constraints. It is a highly coordinated dance. Now, I see this all the time, especially with early-stage startups. It is a super common trap to try and merge the PM and PO roles just to save a bit of money. But in fintech, doing this almost always stalls go-to-market timelines and causes massive tension between product and engineering. Think about it. When one person is running around trying to pitch investors, review audit logs, and manage daily developer sprints without a project manager to steward the risk, crucial priorities get abandoned, and that leads to completely disastrous regulatory gaps. Section 3. Compliance as a feature.
All right, speaking of regulatory gaps, we really need to completely reframe how we view regulation in 2026. Compliance isn't a blocker, compliance is the actual product requirement. Challenge yourself with this. What happens when you design a beautiful, highly engaging rewards program, but you completely ignore the balance sheet? A traditional tech PM might brag about increasing a reward redemption rate by 10%, but a fintech PM knows that every single 1% increase adds massive accrued liability. You always have to ask, who actually pays when users redeem this? Because if you don't know the exact answer, you're building a liability. You're not building a product.
Let's actually map this out step by step to see how it builds in the real world. Say you make a seemingly simple UI tweak to the user onboarding flow. Boom, that instantly triggers KYC and anti-money laundering verification. That verification process in turn dictates your reserve allocations, which finally impacts the heavy back-end settlement and reconciliation. A PM who views a money transfer merely as a simple user journey is going to fail. You have to see it as a rigid sequence of hold states and FX triggers where every single step has to generate an absolutely immaculate audit trail. And look, getting those steps wrong is incredibly expensive. Right now, even very mature fintech programs only see a 5 to 20% AML alert to conversion rate. Do you realize what that means? It means when the system flags suspicious activity, up to 95% of those alerts are false positives. More than 80% of a highly paid compliance analyst's time is completely wasted chasing ghosts. Optimizing that conversion rate is absolutely critical because AML compliance is very often the single largest operational cost driver outside of actual customer acquisition. So it all boils down to this brutal reality check for product teams. It's not agile velocity, but audit trail completeness that is actually going to get you promoted in fintech. Reducing that exception rate and limiting the surface area for regulatory penalties, those are your true KPIs. Every day, you are actively managing the friction between legal's strict demand for zero exposure and engineering's timeline of needing 6 months to build it. Section 4. AI and product-led growth. Okay, but it's really not all doom, gloom, and endless regulatory red tape. Modern teams are actively leveraging some truly groundbreaking technologies to fix this. For example, the Reserve Bank of India recently noted that the adoption of generative AI in banking will result in a massive improvement to operational efficiency. We're talking almost 46%. By transitioning away from manual KYC verifications and those clunky static rules engines over to Gen AI-driven models, institutions can finally slash those false positives, automate fraud detection, and drastically speed up user onboarding, all without sacrificing an ounce of compliance. And that kind of massive efficiency gain, that unlocks the holy grail of modern software, product-led growth, or PLG. In a true PLG model, the product itself drives your acquisition and your retention. And this is really where the business analyst becomes the hero of the story, mapping out exactly how a user journey can deliver value entirely autonomously. No human sales rep, no manual verification agent stepping in to slow things down. Features like instant account funding, API-driven modular access, and deeply contextual support are just baked right into the product's core architecture. But here's the catch. Implementing PLG is incredibly difficult for those legacy banks. A staggering 86% of financial institutions cite regulatory complexity as their primary reason for prolonged onboarding timelines. Their intensely manual verification workflows and disconnected data silos introduce so much friction. To actually achieve product-led growth, legacy banks literally have to modernize their digital stack to an API-led, cloud-native architecture that can seamlessly handle adaptive, automated compliance. Section 5, the 2026 Fintech Playbook. All right, so let's bring it all together. How do we successfully build and scale financial technology today? Here are your critical playbook takeaways. First up, properly staff your teams. Keep the PM fiercely focused on strategy, the PO on tactical delivery, BAs on those stringent requirements, and project managers on execution risk. Second, Optimize your teams for risk-adjusted metrics. Start prioritizing product-qualified leads and exception reduction over meaningless vanity metrics. Third, if you happen to be at a legacy institution, please don't attempt a massive Big Bang core migration. Instead, use a brownfield thin slice strategy. Start with just a single product on the new infrastructure. And finally, you absolutely must embed compliance, KYC, and flawless audit trails right into the product by design from day one. I want to leave you with a question to really chew on as you go back and look at your own product roadmap. Are you just building for user delight, or are you architecting for systemic survival? Because in 2026, the winners definitely won't just be the ones with the best user interface. They're going to be the teams who have mastered the balance sheet, creatively navigated their legacy tech debt, and completely turned regulatory compliance into a massive competitive advantage. Thank you so much for joining me on this explainer, and I'll see you next time.